Greetings, it is time for our monthly inflation update. Now, as longtime viewers know, I have put a multi-dimensional structure in place to measure inflation so that we're not dependent on just any one index, so as to avoid accusations that the CPI is rigged by the US government, as well as to avoid single country bias. The economy is a worldwide entity, and we have to treat it as such. Because to look at the inflation metrics of just one country, even though quantitative easing is worldwide and commodity prices are priced worldwide and traded freely worldwide, is just not accurate. So therefore, we go to my three standard metrics of inflation, and I require all three of these to be above 3% before I say that inflation is higher than optimal. If all three were exactly 3%, I say that is when inflation is optimal. Not that it's about to be too high. This is optimal because deflation is also bad, and insufficient inflation means technological progress is sluggish. This would be optimal. Higher than this would start to become worse than optimal. Number one is the US CPI, 10-year compounded annual growth rate. Is that 3%? Number two is the Goldman Sachs Commodity Index, perhaps the most important of the three. Is that at a 3% 10-year compound annual growth rate? Because that involves commodities that are priced worldwide and traded worldwide. So it's not riggable the way some people claim that the US CPI is rigged. And it's traded freely worldwide, so it's very comprehensive and holistic because oil, natural gas, gold, everything is included in that. And the third one is the 10-year US Treasury yield. Now, 3% is a very low level for this because a healthy yield curve that has a 3% spread between the Fed funds rate and the 10-year US Treasury yield would involve a Fed funds rate of 0 when the 10-year yield is 3%. So the 10-year yield is the one that can most easily go above 3%. However, in a world of exponential technological deflation, you'll see how even this is pretty difficult and portends to the future about how we are in an exponentially deflationary world, and that's why quantitative easing has to be done exponentially and permanently. So what are each of these three metrics today? June 19th, 2022. So as usual, we will check on all three from the official sources. So for the US CPI, we go to the bls.gov website, which you see over here. Click on this graph icon over here. So this is the official CPI data, and let's see what it was over 10 years. So for that, we take this number, 291, divided by the number exactly 10 years prior, which is 229, and that gives us the 10-year inflation rate. So 291 divided by 229 is 1.27. 27% inflation over 10 years. What does that come out to on a per year basis? So we take the 10th root of this. I hope everyone understands the arithmetic of this. The 10th root of this number gives us the annual percentage growth rate, 2.4%. So the CPI growth rate over the last 10 years has been 2.4% a year. Sometimes lower than that, sometimes higher than that, but the average annual growth rate has been 2.4% a year. Right now, for the last 1 year, it's been higher than that, but we have to see this in the context of a 10-year moving average because short-term fluctuations get smoothed out. Look at this 1-year annual growth chart over here of the CPI. There's people who screech about how it's 8% higher than last year, but they don't look at all the 9 years before then when it was close to 0 in early 2020. Or 0 for almost all of 2015. The average is 2.4% a year, which we just saw. And yes, it's high right now, 8%, but it's already peaking, and it takes a lot for this average to get above 3%. There's one commenter who shows up over here and says that data doesn't matter, how he feels ultimately matters, and he says that the 10-year window is wrong, but something that's too short, like 2 months, is also wrong, because both the 10-year window and the 2-month window show not very high inflation. He says only the 1-year window matters because that's the one that shows inflation is high, because he has emotionally decided that inflation's high and he's going to be scared and anxious about that, and only data that fits his preconceived notion is what he'll consider. Now, if he keeps making additional comments over here, I will feature his comments in a video so that we can make fun of him. So this was the CPI. Now we go to the next metric, the Goldman Sachs Commodity Index. Goldman Sachs Commodity Index, the links for all this will be in the description box below, of course. So the 10-year compound annual growth rate of the Goldman Sachs Commodity Index is 2.61%. That is higher than before. It used to be negative for a long time. Now it has risen to 2.61%, and that's approaching 3%, but it's not quite at 3% yet. The United States has deliberately chosen to halt domestic oil and natural gas production, so the price of both of those has risen a lot, and that has unfortunately boosted commodity prices, but it still is not high enough to be at 3% a year over a 10-year window, and the demand destruction that oil is facing right now is just immense. So this is very, very hard to boost into high inflation, certainly in the high-tech atom age. So 2.61% for the Goldman Sachs Commodity Index. Now we go to the third and final metric, which is the 10-year U.S. Treasury Yield. This is the 10-year U.S. Treasury Yield, and 3.24% is the yield. So yes, that one is above 3%. Now this is the 5-year chart that shows how rarely it's been above 3%, only for a few days in the last 5 years, and it quickly plunged after the fact to be much lower, and I suspect the same thing is going to happen here, because when this yield stays too high for too long, the real estate market crashes, because the Federal Reserve has cornered itself in that it buys only treasuries like the US 10-year treasury and mortgage-backed securities, and you can't have low rates forever and ever, because the amount of assets you have to buy to sustain those low rates rises exponentially, and that market ultimately shatters. It's very obvious the Federal Reserve has to send money directly to people. They just have ideological resistance to that, which is going to cause a lot of hardship for people before the PhD economists come to the logical and necessary conclusion, which I wish they would come to without all this turmoil, but they're not going to. So the 10-year U.S. Treasury yield is 3.24%. That one's above 3%. So now we go back to our table. U.S. CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, and 10-year U.S. Treasury yield, 3%, 3%, 3%, are the thresholds that I have consistently set forth. So what are the readings this month? 2.4% for the U.S. CPI, as we saw, 2.61% for the Goldman Sachs Commodity Index, 3.24% for the 10-year U.S. Treasury yield. One of these three is above 3%. The other two are not yet. They are rising though, but I do need all three of these to be above 3% before I say inflation is higher than optimal. Not in a crisis mode yet, but higher than optimal. Optimal would be for all three to be exactly 3%, because that's when you have the maximum amount of technological progress in relation to the least amount of pain for average people. And before anyone pipes up and says deflation would be good because deflation means that people would pay less. No, deflation is far, far, far worse for people than moderate or even slightly above trend inflation, as I explained in this video, which is in the tile in the right-hand corner up here. So spare me the lecture about how all inflation is bad and deflation is good, because that is one of the most ignorant things that a person can say. Of course, saying such a thing is a fad, because everyone wants to sound knowledgeable on this subject, and relatively few people are, and therefore there's a tremendous amount of misconception and miseducation about this topic. But that was the inflation update. I hope you found this informative, and a welcome dash of truth that counters the scaremongering narrative of the mainstream media. But the Federal Reserve should not be increasing the Fed funds rate, nor should it be unwinding quantitative easing, because that will cause a stock market crash, which is already underway to some extent, and they will simply be forced to resume quantitative easing again. If you like this type of content, I encourage you to hit the notification bell and subscribe to this channel. Thank you very much for watching.